Hey everybody, Mortgage Seth here. Today's tip I wanted to talk to you about is what it takes to qualify for a mortgage, and just give you some quick examples of how to calculate for yourself exactly the range that you're going to be in for qualifying. So today I want to talk about a $10,000 a month earner. So the thing that the bank is going to look at is called your debt to income ratio. So if we start with the $10,000 as your income, we have to look at your overall debts. And what that is, it's whatever's on your credit report plus your new mortgage plus taxes and your insurance. So all these things together are going to be your new debts that we're going to compare to your income, and that's how we're going to come up with the debt to income ratio. So let's just assume that on your credit report you've got a car payment, maybe some student loans, maybe some consumer debt, monthly credit card bills. Let's say that all totals up to $1,000 a month. And then your new mortgage for your taxes and your insurance, that's what we're going to try to figure out, so we know exactly how much your payment is and how much you can qualify for in the new mortgage. So if you have $10,000 a month of usable income and you have $1,000 on your credit, then that's going to reduce your usable income down to $9,000 per month. And what the bank's going to do, we're going to take a ratio of your debt to income, and the maximum is usually about 45%. For some programs it's lower, for some programs it's higher. For example, on an FHA loan, they'll allow you to go up to 55% of your total debts to income on your ratio. But for this example, we'll just use 45%. Got my handy dandy calculator here. So I'm going to multiply $9,000 times 45%, and that gives me $4,050 a month that you can use for your usable income to qualify for the mortgage. And that's going to cover your mortgage, taxes, and insurance. So I'm just going to use some round numbers to make the math easy. Let's say that your taxes are about $1,000 per month. That would be on the high side. And then let's say your insurance is maybe $50 per month. So what we have to do is we have to take these numbers and subtract them from the usable income. So the 40/50, we're going to subtract 1,050, and we're going to come up with $3,000 per month of usable income. And that's after we've taken into account the debt to income ratio and the other debts that you have on your credit, plus the taxes and insurance. So now we've got, out of your $10,000 a month, we've got about $3,000 of usable income to qualify for the mortgage. And a really easy thumb rule to use is for every $100,000 in mortgage debt, your payment is going to be around $500 a month. So if we've got $3,000 in usable income, then that gives us about a $600,000 mortgage that you'll be able to qualify for. And remember, that's after your down payment. So $600,000 should be the range that you can qualify for if we have this $3,000 usable income at the end of the day after going through this calculation. So that's a quick breakdown of how you can calculate your debt to income ratio, what you can qualify for. If you need more specifics, contact me, mortgageseth.com, and I'll talk to you soon. Thank you.